7 Rules of Cryptocurrency Trading for New Investors. For many people, cryptocurrency has been a hot topic for many for quite some time now. Not many completely understand the concept, and it can be overwhelming if you're not familiar with the market yet. Like any other fundings, here it is better for you to first dip your toes into the crypto pool before you go in deeper. Investing in cryptocurrencies is the better way to learn about them. It's a high-risk, high-reward game, and you must be able to digest very high volatility. Financial literacy is highly low, and many people lack a basic understanding of financial management. A record number of people have collected a record level of debt. So guys, welcome here to Crypto World. We will tell you about the rules of cryptocurrency trading for new investors. So stay with us till the end of the video so you don't miss out on any of this information. And before we proceed, don't forget to subscribe to our channel and click on the bell icon so you do not miss out on any of our wonderful videos in the future. And let's get started. What are some simple rules of economic management we should follow? Financial analysts claim it's not so simple. Financial investments are congenitally complex, and simple rules beyond do not put all your eggs in the same basket directives are hard to acquire. Some help can come from the unexpected domain of cryptocurrency trading. In contrast to traditional financial instruments like bonds or stocks trading in Bitcoin and other cryptocurrencies, the trading attracts a much younger and digitally wit crowd. They share lots of information and trading techniques on specialized online forums, and most apparently on Reddit. There, you will most surely encounter the use of several acronyms omnipresent in the world of crypto. Using these catchy and short abbreviations, cryptocurrency traders simply remember the most important rules of trading that optimistically help them to avoid costly mistakes. But non-crypto investors can learn how to use them too. Many of the fundamental concepts have their origins outside the cryptocurrency world, but have borrowed and appropriated accordingly. For example, FOMO, F-O-M-O, refers to the fear of missing out, coined by Patrick J. McGinnis in a 2004 op-ed issued in the Harvard Business School magazine, The Harvest. It refers to the fear of missing out on high returns triggered by recent, often extreme increases in the market value of a benefit. FOMO triggers newcomers to place large investments after certain jumps based on the inherently human percipient bias to extrapolate the future from the past. Common trading wisdom contends the opposite and generally advises to buy at the end. Now I'm going to tell you the 7 rules for soon-to-be crypto investors. The first rule is the crypto craze. As we know, crypto prices have soared in the last year, giving investors mind-boggling returns. Even after the recent decline, the price of a Bitcoin is nearly 400% of what it was a year back. According to China Analysis, a leading provider of investigation and deference software in Indian households, which have been forever known to give love for gold funds in crypto, grew right from almost $200 million to nearly $40 billion in the last year. Regulatory uncertainty is no bar new, and many investors are finding favor with this currency, which is now finding counterparts being drawn with gold. Cryptocurrencies are a new fund class with very little data for fundamental analysis or old performance. So if you are a new investor getting tempted by the returns and planning to dip your toes in the water, it'll be tough for you to make an informed decision. Here are 7 rules of thumb to remember when having this high-risk, high-reward arena. The next rule is not to go all out. The phenomenal returns given by some cryptos in the past year are mouth-watering. $10,000 invested in Dogecoin 6 months ago is now worth $575,000. But do not get carried away by these numbers and take large bets. Even if you have a high-risk desire, then start small. Do not allow more than 2% of your overall portfolio to cryptos. After you get familiar with the field, then learn about various coins and understand their value and prospects before assigning more. The next rule is you have to prepare to stomach extreme volatility. Funding in cryptocurrencies is the best way to learn about them, but in this high-risk, high-reward game, you must have the appetite for intense volatility. Bitcoin smashed through $50,000 in February, and the May 2021 crash showed an overnight fall of 70 to 80% and can also be expected. Keep in mind that even a blue chip like Bitcoin is down 48% from its April high. The next rule is to use reliable platforms only. One of the biggest barriers preventing the wider adoption of cryptos is the surrounding regulatory uncertainty. A year before the Supreme Court quashed a 2018 rule banning crypto trading by banking entities, outcoming into a trading surge. The crypto space continues to be unchecked in India, and new outfits crop up on a daily basis. Though the Supreme Court has currently struck down the RBI ban on cryptos, and even the government has hinted at taking up a calibrated reach towards industry regulation, investors need to be careful when choosing the negotiator. Investing via an overseas platform may need greater compliance on the tax front. The next rule is to verify all information you receive and then only move forward. Another byproduct of the unchecked nature is that the crypto arena suffers from a major deficit of legal information. Investors are dependent highly on unverified information circulating on social media, and sadly, social media these days has less fake news. Self-styled crypto analysts make WhatsApp groups packed with their accessories who vouch for their accuracy. These analysts trap credulous investors first by charging a fee for the tips and then using them for their pump and dump operations. You must verify the information before you invest. The next one is you must priorly focus on blue chips. Like stock markets, the crypto market also has penny coins and blue chips. Do not hoard obscure coins just as they are at cheap valuations. Bigger coins may be expensive, but are more stable and reliable. In fact, you need not worry about costliness at all since you can just buy in parts. Bitcoin is the blue chip of the crypto space and operates the overall market sentiment. Focus on the blue chip coins like Bitcoin and Ethereum, with some of your money on appearing counters like Dogecoin. The next rule you must know is to keep an eye on global developments. The crypto market is a global name, which is why global developments can impact assets and prices, so one needs to keep up with the happenings in key markets like the US and Europe. Crypto trading is 24/7, unlike in the case of stock markets that have closing and opening bells, so one can act immediately. The next one is to take note of tax features. There will be a tax owed on the income from crypto trading. Even though cryptocurrencies are not particularly mentioned in the Income Tax Act, not yet at least, income in any form from any source is taxable unless particularly exempted under the Act. Cryptos now are not considered a currency by the RBI, so they must be treated as capital benefits, which means short-term gains will be added to income and taxed at normal rates, while long-term gains will be taxed at 20% after indexation. Basis the volumes and frequency of trading the income can be treated as business income too. When you invest in direct justice shares and stocks of companies, you probably are at the intermediate, if not the advanced level of equity investing. Splashing in stocks is a level higher than investing in mutual funds, so most probably you have the right cherry-picking skills. Then, what comes in the way of your booking benefits? Why does your investment portfolio aspect more errors between the trials? This may be a sign that you require to work on your exit strategy if you fail to book benefits on many stocks, even after doing sufficient research and analysis. If you are a thorough, fair play market investor who has mastered the art of entering one or more stocks with wealth creation as your target, you will find that you will not be quite able to make money from the market unless you get both your entry and exit techniques right. And that's going to do it for today's video, guys. We sincerely hope you enjoyed it. If you did, please click on the like button and make sure you share it with your friends and family. And if you have any questions or comments for us, please share them down below in the comment space. And also don't forget to subscribe to our YouTube channel where you'll see even more of our incredible videos. Hey, we'll catch up with you in our next video. Thanks for watching!